Hey. Hello. How's it going? Welcome to my channel. I don't see a whole lot of young people, especially women, talking about finances, and I think it's such an important topic to be able to become financially independent, free and empowered. I was a business major in university, and so I have a little bit of experience from that as well as just research I've done on my own. This video is really fun for me because I honestly probably put like 3 hours of research into this to make sure I'm sharing helpful information. So I went to a bunch of experts, gathered tidbits from them, and wanted to make it in one concise, nicely packaged video to share some basic information for you. This has been a fun process for me because I've learned alongside you, and I'm going to share some of my personal experiences as well. So if you have a little to no knowledge about investing, but you want to learn more, and you want to learn how to invest your money, then this video is for you. I'm also going to include some other great resources in the description below to learn from, if you want to dive further, which I highly recommend. I'm going to talk through some terms for those of you that maybe don't really have any knowledge of finances or financial terminology, and then kind of go through some different steps as well as some great ways to start investing your money today. Also, stay tuned for later. I'm going to be talking about stocks, and that section of the video is sponsored by Robinhood, which is a platform I am a big fan of coming up soon, as well as talking about some other ways to invest your money. So before you're considering investing, you need to kind of take a look at your finances, and I highly recommend trying to follow these steps. First and foremost, it's very important to have an emergency fund. I talked about this in one of my other financial videos, but this is just a great rule of thumb. You never know what's going to happen. I mean, we're literally living through a pandemic if that doesn't show to you enough that you never know what's going to happen. If you need emergency savings in case you lose your job or something, just look at the news across the board. It's recommended that you have a month of money in your savings for an emergency, and then to slowly grow that to 3 months to 6 months. The second step is to pay off debt. It's very important to eliminate debt as soon as you can because that's going to set you back in the long term. And with any high interest rate debt, you want to get rid of that before you start making any big investments, because that's just money that's going to keep going down the drain if you don't address it. The third is to open a retirement account. And I think I'm going to make a whole separate video on this. Again, as I talk about the past, I am a passionate advocate of starting your retirement as soon as possible. I personally started mine when I was 9. I opened a Target Retirement Fund account through Vanguard. So basically there's different types of retirement accounts. Some of the most popular ones are 401s and Roth IRAs. So are generally set up through your workplace. So if you're working a 9 to 5 or some other type of job with benefits, there's a chance you have a So in itself is an account that holds investments. So if you have a through your job, you're investing, you're doing great, you're preparing for your future. I'm proud of you. So is a tax advantage retirement account where you put money in, and your company is going to most likely match to a certain percentage how much money you put in. Through this, you're automatically being invested in a mixture of stocks and bonds through mutual funds, which we will break down in just a second. There's also Roth IRA account, which is another retirement savings account that allows your money to grow tax-free. So let's break down a little bit of those terms. So if you're unfamiliar with what stocks, bonds, the stock market is, let's talk about it. I'm going to try to make it as simple as possible. So a stock is an investment that represents a share in a company. So let's take Facebook for example. You can buy a stock of Facebook, which means you basically own a little piece of Facebook's big old pie. And so as that company grows, your stock is going to grow slowly with Facebook. The stock market that you always hear people freaking out about is the marketplace for stocks, and where stocks are held. So it shows all the different shares of company ownership and how they're performing overall. The interesting thing about the stock market is that it's generally controlled by investors' emotions. So people are starting to freak out because let's say there's a pandemic. They're going to want to pull their money out and sell those stocks and shares. And if a bunch of people do that once, that's going to cause it to drop. But then as soon as they're starting to feel like, okay, this is good, I'm going to reinvest my money in the stock market, the stock market's going to go back up. You often hear people talking about investing with risk versus reward. So you're going to have to risk more if you want a higher reward and want to try to get more money. But there's also lower risk investments, which means you're going to have a smaller reward profit margin. So you're going to make less, but you're risking less as well. So a bond is something that falls in that kind of lowest category. A bond is a contract with the company or the government where essentially loaning them your money. And so it's very predictable. And over a long period of time with that loan, you're going to make a little bit of money off of it. So it's considered a low-risk investment. Funds is basically a big old bowl of stocks and bonds, etc. So I was watching a video and someone explained it. Buying a stock is like buying one single flower, but buying a fund is like buying the whole damn bucket with all a bunch of different flowers. So there's different kinds of funds. And the ones I'm going to be talking about primarily today are index funds and mutual funds. So mutual funds came along first. And like I said earlier, a fund is a big old bowl or bucket of stocks and bonds, and it's managed by an investor. So some very smart guy or girl who understands the stock market is managing a fund or a mutual fund. And they're using their brain and their knowledge of the market is selecting which stock, sponsors, etc. they think are going to be the best investments to include in the bucket. So basically, you're owning a bunch of stocks in one package. So there's more diversification because if you were to invest in one stock, let's say you buy a whole bunch of Facebook and Facebook just plummet, all your money is going to go down with Facebook. That's why it's very popular to hear that you need to diversify your portfolio. Basically, don't put all your eggs in one basket. Mutual funds came along for that reason, to be able to invest in stocks, but to diversify across a larger platform. These are run, like I said, by some smart man or woman. And they are going to charge a big old fee, maybe like EK or DUI of your mutual funds. So however much money you're putting in there, you're paying them a little bit later. Along came index funds. Now, I'm a big old fan of index funds. So is Warren Buffett, may I add, one of the most successful investors in the world. If you don't trust me, trust Warren Buffett. He knows what he's doing. Similarly, an index fund is a portfolio of certain investments that you can buy into, and then you own a little baby share of a whole bunch of different stocks and companies. Index is a representative sample of the stock market. So it's similar to a mutual fund, but instead of being run by some, like, fancy manager, it's passively managed by a formula. So instead of like a mutual fund where you're trying to beat the market, you're basically trying to match the market. So big difference is that you don't have that mutual fund manager, so you're going to cut out a whole lot of costs. So an index fund is something that you usually invest in. You're going to sit on for a while and not touch it. One thing to keep in mind is all index funds are mutual funds, but not all mutual funds are index funds. It's kind of confusing, I know. Basically the way this grows is through compounding interest, which is basically reinvesting your interest into your initial loan or investment on mutual funds. There's no interest paid, but you might have dividends or capital gains reinvested to compound over time. So looking at InvestorGov here, here's a compounding interest calculator to get an idea of how this would work. Let's say you put a EK, 000 in index fund. Let's say you put like EK 00 month. Length of time, let's say 10 years. Say we're going to put out a hopeful at and calculate annually. Look at this number. You originally put in just 10 shot, 000 of your own cash, and because of compounding interest, it grows to EK 000 in 10 years. So imagine if you were to put in a higher number of initial investment, more money each month, or to do an account that has a bit of a higher annual rate of return. Okay, so now you know a little bit more terms, so we can dive into some of the best ways to invest. Like I said earlier, putting money into a retirement account is a great way of investing. Highly recommend it. The sooner you start, the better. Retirement accounts like a Roth IRA, you max out. I believe it's around 0.00 is the max you can put in a year. So let's just say you make a ton of money one year, and you want to invest a lot of it. You're a little bit limited when it comes to that retirement account. But even if you don't have that much money to put into investment, I'm sure there's quite a few of you guys. Don't worry. Just put in a little bit every single month, and it will pay off. So now you know, make sure you have emergency savings. Pay off any big old debt that you have. Invest in your retirement. Let's talk about some different ways to invest. So when it comes to investing, like I mentioned earlier, there's different approaches. You might want to be more high risk, high reward. That could be somebody that's trading in stocks and is much more hands-on. And then there's also a more passive, A little bit lower risk approach like investing in an index fund. So there's different types of index funds you may have heard of, like this Bat Shunno Shunno. That's a super popular one. So what is this Bat Shunno Shunno then? So glad you asked. So the Bat Shunno Shunno index basically tracks the top Bat Shunno Shunno's companies. If you're in a different country, it's going to be different for you. Some of these basic principles hopefully apply to you. So there's slightly different Bat Shunno Shunno funds depending on the brokerage account that you sign up with. I personally am signed up with Vanguard, which is a very popular one.